Ever wonder why option prices spike or crash unexpectedly? The culprit is often imbalance. Let's break down what it means and how you can use it to your advantage. Imbalance happens when there's a mismatch between buyers and sellers in options. If too many traders buy call options but few are selling them, prices surge. It's like a concert with 1000 fans, but only 100 tickets, prices skyrocket. Three main reasons cause imbalance. First, market sentiment, fear or greed can flood one side. Second, events like earnings reports or Fed announcements trigger rush orders. Third, big institutional moves create waves smaller traders can't absorb. Smart traders exploit imbalances in several ways. They use contrarian plays. If everyone's buying calls, it might signal over optimism. They anticipate volatility. If puts suddenly surge, a drop could be coming. And they hedge against large price swings. Imbalance doesn't just move option prices, it impacts the underlying stock. Market makers adjust hedges, causing ripples in stock prices. Plus, low liquidity amplifies the chaos. Imbalance isn't good or bad, it's a signal. Watch order flow, track put call ratios, and stay alert to news. Use it to spot reversals or ride momentum. But always manage risk, it's a wild ride. Trade wisely. Subscribe for more.